That's right. The big, beautiful bill has passed. 100% bonus depreciation is back. CRE investors are rejoicing, but maybe not so fast. There's a lot of other things in this bill, probably mostly good for real estate investors. The rest of it, maybe it's a mixed bag depending on your thoughts, but we're right back into tariff talk, tariff world. I mean, literally just a couple days later, after the bill was signed July 4th, we have renewed discussions of tariffs with a July 9th deadline. But we're here to talk about multifamily real estate in 2025. And we're going to be discussing what the intersection is of tariffs, new tax bill, and multifamily, along with other trends related to rent growth, loan delinquencies, and more. If you're at all relatively interested in the multifamily industry, you're an investor, you're an owner, you're an operator, you're in the property management world, or you're just someone who likes to learn about economics, understands that housing is such a critical component to the U.S. economy. It can be a little bit of a bellwether on where things are going, especially if you're interested maybe where inflation and interest rates might go. Real estate gives you a little bit of a key. You want to stick around and watch this whole episode of The Gray Report. It'll be really exciting. Let's get into it. Welcome back to The Gray Report. I'm your host, Spencer Gray, President and CEO of Gray Capital, host of The Gray Report, joined once again by Director of Communications and Marketing here at Gray Capital, Dr. Matt Bosnagel, producer of The Gray Report. Matt, there's a lot of news over the weekend. Again, some of it maybe not directly related to commercial real estate, but some of it really directly is. Talking about this, the big, beautiful bill that was finally passed. Went through a lot of iterations after getting passed in the House, the Senate, reconciliation, and just like clockwork, almost by design, renewed discussions, ramped up discussions about tariffs. It seems
stirring
like
the pot, keeping it
as
spicy.
soon as we have a little sense of clarity and certainty, this uncertainty comes right back to us and hits us square in the face. We're going to talk about tariffs here in a minute, but first we want to talk a little bit about some of the implications of the big, beautiful bill. And I think there's a lot of real estate investors out there that have mixed feelings.
Yeah, I think that those mixed feelings are appropriate.
Yeah.
I also think that this TREP article that was written in July 2nd, so it was before it passed, but after everything materially was in place in the bill. But I think that it does a good job of identifying like the real major parts of it.
They wanted to get a good analysis before they left.
Yeah.
For July 4th.
Oh yeah, that's good. That's good. The Senate was hard. The House was hard at work, but TREP had clocked out at that point.
Yeah.
So basically, and you noted this at the top, the bonus depreciation is one big thing. They also made some changes to permanently kind of expand LIHTC, low-income housing tax credit. It was there was a tax credit of 4 or 9%, depending on what the time frame was. But now it's expanded to 9%. And
it increases the allocation of the 9% LIHTC credits.
Yeah.
Which is more affordable housing. I mean, what that means is more money for housing development in the United States.
Yeah, and I think that's great. I think that there are some things that are, I don't have a problem either with opportunity zones getting expanded. I think that there's another one, this Section 899, which barred foreign investment. They cut that out of the Senate bill, so that's going to be, more foreign investors can invest in, which is probably, good news for CRE investor, the CRE market that is, looking for something. Maybe sometimes the investors are going to come out from outside, and so that barrier is not in place. But the upshot for all of this is deficits, I think. I think that's the risk, and because the deficit side related to where the long end and the yield curve, where bonds interest rates are going to go, because of the perceived risk of larger U.S. deficit, rising debt. Can the U.S. support it? What's the interest going to be on U.S. debt and bonds? Yeah.
That I think is yet to be seen. I think there's different ways of forecasting and modeling. The CBO has had different levels, different estimates, and then when you bring in this factor of tariffs and tariff revenue, that also throws a wrench in the gears, because you either could say, oh well, look, we're actually getting all this tariff revenue. You could also say, well, how long are the tariffs are going to be enacted and at what rates? Before we get into all that, Matt, I feel like we glossed over 100% bonus depreciation.
Yeah.
Is that's a big deal. And if you've been investing in multifamily over the last 3, 4, 5, 10, 15 years, you understand it's huge. It's not just real estate. It's not just multifamily. It's all of the types of investment. It's for factories, but for a real estate investor, it's incredibly attractive, because you can receive a huge percentage of like the investment that you make. So what it means is like an LP investor, just a regular, normal, passive investor. You invest into like a syndication, for example.
Yeah.
You're going to be able to get back a significant amount of what you invested back as a paper loss on your K1 in that year, because you're allowed to take instead of taking a depreciation schedule, over 30 years, depending on what the product, whatever the component is, there's different depreciation schedules.
Little tax breaks over 30 years.
Yeah, over time you can accelerate all of those deductions in the first year. And so what you'll typically see on your first year one tax return, especially if you do like a cost segregation study and analysis, is that you have this massive loss in year one, because it's basically taking all of those components are going to depreciate over that scheduled period of time. You're taking that full loss, which allows you to offset yield and income over the next several years. So that allows a real estate investor to essentially shelter all of the income and distributions that they receive from that property. So, like, real life example, you could receive $100,000, $1 million of distributions, but the IRS sees that you lost money, that you have a negative, a negative amount of income for your K1.
And before, they were trying to phase this out, or at least dial it down.
It was in the process of being phased out. So this first went into effect in 2017 at the Jobs and the Tax and Jobs Act that was passed in the first administration, and that led to a ton of investment in multifamily housing. There was a little bit of cap rate compression, but it allowed for it to be so much more investment in terms of in terms of a tax shelter.
Wait, so in 2017 they allowed for bonus depreciation?
Yeah, they allowed 100%.
Okay.
It went to 100% in 2017.
Okay.
And then a couple of years ago it started to phase out. It was 100, then it was 80, and then it was 60. It was go down to 40.
Yep.
If you're a multifamily investor, you've noticed over the last couple of years on a new acquisition, the amount of losses were much less than they were in previous years, which means you had fewer losses to shelter gains. And so not only can you, if you're a real estate professional, again, none of this is tax advice, talk to your CPA, but what you can do, you can take the losses from one property and apply those losses to the gains of another property. So as long as, if you're selling a property, it's kind of like some people call it the lazy 1031 exchange. And it's because at 1031 exchange, there's a lot of rules, there's a timeline, a lot of rules actually. But just by using depreciation, as long as you acquire a property in the same tax year as you sell it, or you can acquire the property years later because the losses carry forward, but as long as you acquire that property to generate the losses, depending on what the investment is, you can shelter a significant amount of the gains from the property you are then selling.
Okay.
And so let's say, for example, you buy a bunch of properties and then you just sell one. There's a good chance you might be able to shelter all of the gain that you earn from that property. Now, there is depreciation recapture. So at the end of the day, if you don't have losses, what the depreciation that you did not actually use does get taxed, but it's at a lower rate than your regular income tax. So it's a much more tax efficient.
Yep.
And again, depending on how you're rolling and buying properties, you can defer those tax payments for quite a long time.
Yeah.
Done this myself, done this for members of my family, done this for our investors. Again, I'm not a CPA. I can't give any tax advice. talk to your tax
But these are
professional.
things that are possible.
But it makes multifamily that much more attractive, and the reduction in bonus depreciation being able to take has directly coincided with the market weakening. So it's like another blow. Rents are low, it's the interest rates are high. Oh, and by the way, you're getting less depreciation and less losses.
I remember there was some discussion of it being an incentive for people to invest before the end of the year, before it gets phased out. And
there are a lot of not the majority, but there are a lot of investors that we talk to that only invest for the losses.
Yeah.
Like, I don't care about the returns that much. I don't want to lose money, but I'm making so much money.
Yeah.
I just need the losses. I'm making money over here. I'm a qualified real estate professional. I need to generate more losses.
Yeah.
So, again, without 100% bonus depreciation, it's harder to do that. You might go other areas, like oil and gas has a lot of tax advantages as well. There's a lot of depreciation. But again, there's other things. You can build a factory and you can depreciate it. You can buy a boat to depreciate it. There's all kinds of different things you can depreciate, but real estate is one of those things.
Yeah, it's interesting that it's not interesting. It makes sense. It coincides with Trump's, first term. He put that 100% in, and now he's phasing out.
And then now they're making it permanent.
Yeah,
they're making it permanent, which is huge. Before it's sunset.
Oh, okay.
The other piece is opportunity zones. They're also making the opportunity zones permanent. Now they are redoing some of the census tracts, I think, for the opportunity zones, which is a really good thing, because when they made the opportunity zones, also part of the first, 2017 Tax and Jobs Act. Some of the census tracts they chose made sense. Some of them were just like all of downtown. Yeah. And like all of downtown Indianapolis, the mile square is just like a QOZ, an opportunity zone. So I think there could be a little bit more nuance and probably like a better process to choose, or just like make it more like project enabled instead of area. But
I agree.
It's a way to defer taxes. There can be some hoops you have to jump in through, like how long you have to hold the property to fully utilize all of the benefits. I think everyone is fully utilizing the benefits, because you really have to own the property for longer than 10 years to get the full reduction.
Opportunity zones, though, these are talking about you get kind of tax breaks or subsidies for building in there.
Tax breaks. Okay. So you have the ability to completely reduce your capital gains liability. Okay. Completely down like to zero if you own the property for a long enough period of time. Okay. I want to say it's 14 years. It's longer than 10.
But we don't talk about that.
We're not opportunity zone experts.
I know.
I'll tell a story when I was asked to be on a panel about opportunity zones, but the other qualification, the limiting factor for like a group like us that acquires properties, you have to make a significant investment. So typically, like an acquisition doesn't qualify for an opportunity zone. Okay. It's typically or almost always. And someone please correct me, because again, I haven't taken a deep dive recently, but it's pretty much only applied for new construction.
Okay. That was why I remember discussing this way back when, and it was something he's like, well, it doesn't necessarily apply to the stuff that we're doing at Gray Capital. Yeah. But it does. I like the idea. I think it's interesting. And what I got from it was a little inflexible. Like they're not everywhere either, and sometimes they're in places where it makes more sense than others. So
you want to know who helped come up with opportunity zones?
Oh yeah,
Sean Parker from Napster.
Oh wow, that's great. Good for him. Really bounced back.
Yeah, right. Was it Tim Tillis? I think he got in touch with the senator from South Carolina, I think.
North Carolina, yeah.
Yeah, North Carolina.
Tillis, yeah. That's funny. Well, thanks, Napster. And thanks again, Napster.
Well, the more you know, Matt.
Yeah.
But all the exciting stuff for multifamily, and there's some other positive things I think from just a tax cut perspective. Yeah, obviously not seeing a tax increase on a lot of folks. A lot of focus has been paid to wealthy Americans that aren't going to get taxes raised. But there are a ton of deductions for just like everybody also. I mean, the huge increase to the child tax credit, no tax on tip, no tax on overtime. Obviously, then there's a lot of cuts to some social services, That's controversial. You could make the argument that maybe some of that needs to happen, neither here nor there, but that's controversial. And then there's also a lot of spending that I think is pretty controversial also, because the whole idea is, we're trying to reduce, deficits over here and budgets. And that was kind of the idea of the Trump administration and Doge. But we're spending all this money on, a lot of it's like on border security and enhancing the military. And that sounds nice, but man, it's spending a lot of money.
Yeah.
And so can we really afford to do all of that? I think there's a lot of people that would have preferred that we just did the tax piece and cut some and didn't do all the spending.
Yeah.
But I can't solve all the world's problems with one bill, I guess.
Yeah, well, and I think that the cuts to Medicare, Medicaid is kind of a can of worms. I won't have time to or won't be able to discuss right now. However, I think that the spending and where it is on the balance sheet is also very relevant. That's what they kind of close on in this TREP article. It basically saying here the quote is, the risk here is that the expanded deficit puts upward pressure on interest rates due to 1, the government's need to issue debt to finance the deficit, and 2, the Fed's need to stabilize inflation. As a result, we're likely to see the long end of the yield curve drift upwards, means a higher cost of capital, maybe higher forever, not higher for longer. And they're also saying, and this may be, I don't know if this is in the article or not, but it's true. I don't think that the real estate market, commercial real estate market, has truly adjusted to higher rates in their pricing. So there's still maybe some more rebalancing they could have. Maybe it means slower price growth. Maybe it means falling prices for some assets in some markets. Depending on the supply demand dynamics. But it's not great news because you're coming at it from both sides. There's that inflation risk and the borrowing debt kind of the government. And I would say, and I don't know if this is included in the two things that is listed in the TREP thing, but also that dynamic between the 10-year Treasury and this like risk-free rate. Is it suddenly going to become a risk-on rate or like a more risky rate, which means that it's higher, it's less. So there's a little bit, that's the uncertainty I would say.
I don't. And so what are the arguments for the bill causing inflation? I guess outside of just interest rates would be higher. That would reduce. It would be restrictive.
I think that they are saying. Well, no, they did say they said that deficits do increase inflation in general because it's just more spending in increases inflation. The more spending that the government does make sense. The one thing in this, we just move on to this Wall Street Journal piece talking about tariffs, and again, I think this is part of the. Who knows if it's going to work? I think it's a little it's wonky. I think that there is some thought to it of they're using tariffs as this tool to kind of tamp things down. They're like the economy, like we said last week, the economy is doing pretty good. If that's their
and they don't want it to they don't want it to overheat. And so anytime that the economy is doing too damn good. Yeah. They just start with a bunch of they restart the conversations of restrictive tariffs, which are essentially a tax and reduces economic activity. Yeah. Knowing that most likely that it will be a little bit of transitory inflation, if that. But there's a lot of data showing that these tariffs, at least the way that they're doing in this current environment, aren't really inflationary. If anything, that they're putting like cold water on the fire a little bit of economic growth when we can't decide if the labor market is cracking and we're getting ready to fall into a recession or where the economy is overheating and we're going to see inflation. Which if you can't decide between the two, that means we're kind of in a sweet spot.
I don't know if the question is that the intention of these tariffs and like there is a complicated game and it does seem a little bit like a game where we have to question whether this is like he's so crazy he might do it or whether he's serious or the kind of taco trade that everyone talked about.
Scott Bessent seems like a pretty smart guy. He's got probably a lot of faults, but he articulates pretty well.
But I haven't heard from the government that their stated aim is to cool off the economy to kind of reduce demand there, and there may be a whole psychological game that they're trying to play with the U.S. I do think that it is a little bit of a bummer that we have to be in this uncertain moment where we can't kind of plan things out for a longer time, and especially because some of the tariffs that they're announcing here are flatly ridiculous. It's ridiculous from my perspective of living in a world without 25% tariffs, but maybe we're in a different world since April or whatever, the Liberation Day in March or when I forget when it was. But maybe we're in a different world where now that's normal. I don't think it is going to be normal. I don't think I think that if these, I'm just going to list them off. South Korea, 25%, Japan, 25%, Myanmar, they also got one of those letters. Do you see he wrote a lot of letters. That was the form of this round. Myanmar 40%, Laos 30, Thailand 36, Indonesia 32. So all of these are 20-30% tariffs on a bunch of different countries, including the EU has a big has a decent sized tariff too. Steel and aluminum 50% tariffs. A lot of big tariffs on a lot of these products. And a lot of them that are listed, that are described in this Wall Street Journal article and others, I was drawn from an Axios article earlier, they haven't gone into effect yet. So they're just kind of on paper. And my worry is that once these really kick in, that there's going to be a dramatic effect. My frustration is that they're not going to happen, and this is just rhetoric, and I don't like being played with. That's my that's my only thing. And I
think that's reasonable. That you don't being kept in the dark, and being kind of like a pawn isn't a great feeling.
Yeah.
And they're just where you're left in a position of being told, hey, just trust us. We got this figured out.
Yeah.
The adults are in the room. We're playing, the 4D chess that you don't understand, and it's going to be fine. Just take it.
Yeah.
And we've said this before. It's just, I don't think it's smart to ever just take any politician's, word for it. And that there should be some idea, some level of certainty, but from, a strategic perspective of trying to kind of reshape the global economy and fight to reposition the United States in a different position than we are today. It probably requires some level of brinksmanship that is I mean, negotiating in general, it's kind of like who is comfortable with being uncomfortable and who's comfortable with being uncomfortable for the longest while everyone else, starts, finally giving in. And diplomacy is like a game of being really nice, pleasantries. And so it's a high risk. A lot of this is high risk, high reward.
Like I said, I can understand the negotiation aspect of it. I think that may be going through their mind against the other countries, but as a mechanism for reducing demand and reducing the United States consumer demand, I think there are better ways to do it than threatening tariffs. But maybe it's just because we haven't done it before.
Well, because the other way to do it is like to raise interest rates.
Yeah, exactly.
But they want help to lower interest rates because they need to have a scapegoat of it's the Federal Reserve is keeping interest rates high, which I think the Federal Reserve they're probably making the right call. And we talked about last week of maybe they should lower the rates. Maybe they should. Maybe they shouldn't. I mean, again, if the economy is doing as well as it has been, and we don't know if we're going to reaccelerate, and Trump is going to, through the tariffs, are going to kind of have the downward pressure on demand. You're kind of getting the restrictive force that higher rates would provide through these tariffs because you're just reducing economic activity. It's just this weird fiscal macro lever that it's like a backdoor, I don't know, a little trick.
Well, I wonder if, and I don't know when, I know that Powell is up for, like, his term expires not, it will be within the Trump.
Months. 6 months, I think.
So, but maybe other board members.
Scott Besson is highly talked about coming in, potentially going on the board,
and it's a whole board. You can't just have one person be setting the rates. But it will be influence. It will be an influence to lower rates. I think that's all but a certainty. And I think that I'd add that to Trepp's article on what could cause inflation? Well, a lot of pressure that comes. I think that there would be a little bit more political pressure to have lower rates. And I feel like the pipeline would be a little bit more direct between Trump and Bessent than a Trump and Powell. And Powell's a little bit more independent.
Full circle, CoStar, rents. All right, Matt, you made a really good point. Sorry, I'm going to jump around. There we go. Sorry. Rents have been flat. Rents have been pretty flat. We've had the lowest rent growth this last quarter than we have, according to CoStar, which we had a whole debate over this CoStar data, because CoStar has no negative national rent growth since 2010, and we all know that there was some negative rent growth at some point. According to Apartment List, we had an extended period of negative rent growth, but according to CoStar, sort of going around, regardless whether it was negative or not. Rent is lower. It's not, I'm showing this because it's related to CPI. Housing, shelter makes up 34% of CPI. CPI is kind of the inflation gauge that most people use.
Yep.
The Fed uses PCE, the personal consumption, personal consumption expenditures a little bit more, but they still look at CPI. And this would show us that CPI would be coming down relative to housing coming down, which that data hasn't fully floated into the system.
Yeah.
But again, if we're looking at the multifamily data, and if there is a lag between this real-time data and CPI, this would show us that CPI would be receding at some point in the future, and there would be some correlation to rates coming down.
Yeah, that could,
as well.
That could be. I think there's also home price growth is starting to stagnate, maybe cool off. There, and I just don't know how much of a lagging indicator the CPI is when it comes, especially to apartments. We've been waiting for things so long, and I also think that it flattens.
How much do you trust CPI?
I trust
do you think it's like a real number, not something that's kind of made up?
Oh, I think that it's a real number if you cut out I just don't trust it necessarily with apartments because I know a little bit too much.
But I guess and not trying to be like conspiracy theorists, but like enough about housing, enough about apartments, and when you see the CPI numbers, you're like, this doesn't make sense. So how much of that would be true with other industries? I'm just
it could be getting worse if they defund a lot of the data gathering from CPI.
Oh my gosh! Well, it's not like they're providing that good of data, Matt.
I guess it's better than nothing. I like it.
We've got plenty of data. They shut down during COVID.
Yeah.
I'm sorry, but they don't even provide good data. Do they provide good data?
Or
do they provide data?
I think that it is in general. It is great. I'm just saying
the one aspect that that is part of your job that you've been doing for years now that you study, you look at it when CBI publishes their housing data and you're like, this makes no sense.
It makes
right.
I try to fit it into my understanding so that they can still be right.
You try to square it, but I'm just saying. I'm not as familiar with, like the food component, and I don't track food prices on a daily, weekly, monthly basis. So I don't know how off they are.
I track egg prices, but only when it's politically convenient.
Exactly. So anyway, I don't know what I was trying to say there other than if at some point real data trickles into CPI and that if housing is a component relative to inflation, you would think that those metrics would be receding at some point in the future, and there's a correlation between that and short-term rates, and then maybe even long-term rates.
I think that's right. If according to what we see in the lags that we know about, especially with multifamily, there will continue to be a lowering of the CPI, so it'll continue to make the CPI inflation
But we've also been
lower.
saying that for a year and a half.
I know, and that's why I don't. Yeah, that's. But I do think that it tends to flatten it. Like it was never as high as it was shown on the private trackers like here.
Well,
it won't never be as low as
rent has been declining since halfway through 2022, right? And it's been lower for the last 2 freaking years, 2023, and we're more than halfway through 2025. So, the growth has receded slightly, but it's still pretty elevated.
And I guess there was no period. I'm not. Yeah.
Yeah. Sure.
I do think we are in an exceptional moment since 2023, and I think this period is weird and it's upsetting and it's very frustrating. That's where I was kind of coming to terms with this whole time on CoStarz, this temporal period from basically 2023 until now, where rents roughly the same. I think that's more of a story than, year over year rent fell off by 0.3%. That could be a blip, could not. I get it. We've crossed the threshold that we haven't reached since 2010, but it's not that big of a change. The bigger story is we've spent the better part of 2 years with rent growth like the same. Like nothing's happening.
Yeah.
And every year, and I'll admit to this, every year we say, oh, improvement's just around the corner. We just have to wait out this year. That was what we said in 2023. Let's just wait until 2024. And then in 2024 we
survive
said that rhyming,
until 2025.
We said everyone's famous poem.
What was the rhyme in everything will be free in 23? What was there?
Know.
Were there rhymes for 24?
I think that I don't.
Was it just survive till 2025?
Yeah, I think that we knew. But it is well into 2025. The fact that things haven't changed when it comes to rent growth is worrying. It made me like, oh no. And then I looked at the context. I was like, well, it hasn't been as bad as it was so if you scroll back all the way to 2010, you've got negative rent growth. So when it was that low, there was actually a downshift. Obviously, it was a great financial crisis, housing crisis. A lot of things were negative, and one of them was apartment rents. And then there was actually also a period in the early 2000s where apartment rents were negative too. So it's not unprecedented that you have a cooling period, even negative, and it makes this period now look a little bit better that it's at least not negative. But the fact that it's calm, like there's like the no wind in the air, and it's almost worse than the storm itself.
I'm gonna mess up all this stuff. I'm gonna just while we're on CoStar. I mean, there's a reason. All things are relative, and this is what this real page piece that we're gonna talk about in here in a second is highlighting. And I guess it's the counter to just looking at the data point of rents are low and they've been flat. Mm-hmm. Yeah, they have. It's because this has been happening. All of these deliveries have been taking place. We've been delivering more units than we have in over 40 years. Yet, despite vacancy rates are definitely high and rent growth is on the lower side, the fact that we are absorbing these units, we have,
like I said, it's not negative.
Positive absorption. And then again, this is just showing the starts declining. But I mean, how many starts there were in 2022 and even 2023, and then there's, I mean, this isn't a full quarter yet, but I mean, we're looking at the lowest amount of starts, the last couple of quarters in a decade or so. I mean, under construction. Anyway, I mean, what we're trying to say here is, rent growth is low, but it's amazing that, I mean, with CoStar's, the data that CoStar is at least purporting to be as true is that we've remained positive. We could build a 40-year peak in supply, deliver 1 million units essentially, and we'll still grow rents. Obviously, we're not growing rents everywhere. The Sun Belt is definitely seeing negative rent growth.
If there's anything that we've learned over the past 2 years, it's going to be a little longer.
Just be patient. Real estate is slow. One question
even CoStar expected last month. I looked at last quarter, and they said we expect rents to accelerate in this next quarter. Well, they kind of didn't, and so that's what's just frustrating.
And I think that we talked about this idea of kind of the time dilation, time compressed, and things are now just expanding and taking a lot longer than. But we accelerated like a decade's worth of growth within a year. So,
and when everything's the same, you do look for what is different, and what is different is the starts that are going down, the apartments under construction are going down. Actually, and a lot of what's different. So we looked over. That's the time period, and so that kind of reassured me, like, okay, I can see a way out when it comes to these things that are happening over time. I also looked at, because it's not fair, if you look at national, maybe there are certain markets, certain regions that are doing better. And I would argue this year, maybe more than others, that the national rent growth numbers are going to be dragged down by like a smaller number of markets. So it's the South. The overbuilding in the South is dragging down the national rent growth number such that, like, if you look at the national average and you're living in Indianapolis or Cincinnati, that's not going to really mean that much to you.
It's meaningless. I honestly think that the only purpose of the national numbers right now is to get an idea of what CPI might be in like when an indefinite amount of time to forecast interest rates.
Yeah.
I don't see really a practical use for them other than to say of like, national rents are negative, but that doesn't really tell you anything, because you said you have to break down, drill through all the regional data to actually talk about real performance. So
yeah, no, I agree, and that's one of the things I did just because I was going through this and just trying to find my way out again of the kind of gloomier numbers of stagnation. I took 7 sample markets these are the markets that had the biggest amount of units that had negative rent growth.
Yeah.
So these are markets like Dallas, Houston, Atlanta, Phoenix, Austin, Denver, Charlotte. So those are the biggest high supply, low rent growth markets. So they make up 17% of the total inventory. But when it comes to the number of newly built units, they have built 26% of all the newly built units were in only, in markets that were only 17% of the inventory. So that's this outsized, overrepresented basically when it comes to newly built units. But then when it comes to units under construction, that skew is a little bit less. So it's like the high supply, they're building a little less. Instead of 26%, it's only 21% of all under construction. Still, they're over, they're surpassing their representation.
They haven't all learned their lesson.
Yeah, yeah. And then I did the flip side. So the undersupply, or not undersupplied, I'd just say like kind of normal markets that have positive rent growth. The biggest ones, New York City, LA, DC, Chicago, Seattle, Philadelphia, and Boston. They had 23.7 of all the units just because they're bigger cities, but only 16% of the newly built apartments. So underrepresented when it comes to positive rent growth. And also the higher percentage of under construction units. So they were underbuilding. Now their under construction is 21% or almost 22%. So basically, the apartments that were building a lot, they're slow. Actually, their construction level is slowing down, and the apartments that weren't building, their construction level is ramping up a little bit, at least relative to the nation. That is a positive sign to me that things are actually reacting.
They're reacting. I mean, there's little development equity anywhere in any regions, even in the growing regions like the Midwest. Yeah. But if you think about, underwriting a development deal, how do you underwrite something when the current environment is negative? In the first 2 years, there's negative rent growth. And the story is we've just built too much. And then you're a developer going to equity saying, let's build some more. Yeah. And when you're probably going to, now that there aren't national and regional developers that can have some flexibility about moving to different markets, but there's a lot of local and regional developers that build in the same markets. And so they're going back to the same investors to build in the same markets. No surprise that it's the regional, local developers that can move to markets like that are in the Midwest and say, hey, look, our development project in Austin, obviously it's slow, all of the supply down there, but we found this market in Indianapolis. Yeah, they built a decent amount of apartments, but nothing compared to the Sun Belt. They're all getting absorbed. Rent growth has been positive. There's little supply in the market, and we can underwrite with data today positive rent growth.
And that makes sense. That should be how the market works. Yeah. I think people just got so psyched, so excited to build in Phoenix. Numbers be damned that we saw this outsized growth in that market.
When you start hearing people just quote seemingly important, and they are important, demographic metrics of there's X amount of people moving into Nashville every single day. Well, it's great.
And I wonder, they built so fast. Maybe the data didn't catch up. They didn't know that everyone was going to build there until they knew it was too late.
100% that happened. I'm sure. I know that. Because this even happened to us, of where we're buying in a market and we're we've only been able to identify these new developments that are being penciled in, and then you see some shovels going in the ground. You see some report, or you talk to somebody, and they're like, oh, there's another deal that's being built because it's been flying below the radar. CoStar didn't know about it. It's not in any publications, and then there's a couple hundred extra units that are going in. They're going to be competition. That happens all the time, and sometimes it's just the data hasn't flown through, or you haven't gotten the information. And again, money became free at a similar period of time. I mean, interest rates went to zero overnight, and it was in halfway through 2020, and that's when we saw this. Once people were confident that the world wasn't absolutely collapsing, sometime in 2020, basically 2020 got over. Everyone was like, let's start building. The money is free. And it took some time. I'm looking at 2021. All of these construction starts, 150,000. in 2020 it was 100, then 150,000 the next quarter, 136, 124, 129, then bam, 200, 188.
Responding both to demand, I think, and interest rates too.
Yeah, they're looking. Their interest rates are near interest rates. Short-term rates are zero. Rent growth is,
That was about peak.
Let's go to the rent growth numbers. Rent growth at that period of time, this is just nominal. Rent growth was, 9%, 8.5% per year. In 2021, end of the year is 9.2, and then it was 9.4 according to CoStar. Other sources have it even higher than that.
Yeah.
So then people are using these 9% rent growth metrics year over year. They're assuming they weren't assuming 9 and then 3, 3, 3, 3, 3. They were assuming 9,
Forever.
10, 11, and then maybe 8, 7, 6, 5, 4, 3. They didn't have, no one had 10, 3.
Yeah.
Some people had maybe 10, 9, 8, 7.
Yeah.
But it was all, none of it made sense. Add those percentages up. Wage growth isn't growing that fast. And so everyone saw all of this, and they all decided in the same, year and a half, let's all build in the same markets across the Sun Belt. We all live in New York City and California anyway. And, these, down in the South where, freedom reigns, we'll be able to do whatever we want, make a lot of money, bring it back to the Big Apple.
Yeah.
They all had the same idea. They sold it to their grandmothers and the pension funds. And let's see if we can have the delay. They probably have and so peaked under construction here in Q1 of 2023, and then we don't have the defaults or anything on this page. But man, I'm skipping around. Is there CMBS data? And looking at these origination LTVs, obviously very high leverage. February of 2022, and obviously wind started getting sucked out of the system. Let's see these maturity dates.
That's only future.
This is only the future.
Yeah.
A lot in 29. Anyway, they don't have distress, but Matt, there is a couple articles out. The amount of just foreclosure sales in Texas this last month was insane. There are a lot. There's a lot of there's decent amount of distress. A lot of the chickens are coming home to roost.
But so that was like the upshot, I think, for this, and even a little bit for the Real Page article, was the regional differences, the difference between markets. And I think that as conditions normalize throughout the nation, as the construction activity begins to be a little bit more even, maybe we'll start to trust and use the national rent growth numbers as more of a yardstick. But again, it pays to pay attention to what's happening in your own market. And I think
these are good metrics, Matt. 108,000 units were delivered. Second quarter 2025, 108,000. But we absorbed. The demand was 227,000. So that's good.
And that's what my own take for all of this week's kind of reports and the update on aside from tariffs and trade policy or anything like that. My take on the multifamily market is it looks bad, but we've never had more information on the turn in the multifamily market and the positive turn in the multifamily market. We are seeing apartment list is an outlier here in how they have seen increasing vacancy, because there's improving occupancy in that RealPage is showing. There's improving occupancy that CoStar is showing too. It's a slight, but it's still there. And I think we have reached the peak of that period of increasing vacancy because of the new supply, and the demand for wherever you look, it is there. It is supporting it. That's why apartment rents have remained positive by CoStar. I think it's just because there's this bedrock of demand that's always been there. And that's what I was going to say too, is they built a long time ago, not a long time, three years ago. It seems like a long time. They built in a response to low interest rates and demand. The only reason why they're not building now is because of high interest rates. The demand's still there. If they could, they would. Yeah. But because of that, because of the fact that they're not building, and we're seeing twice as much demand as there was supply, which I would never could have imagined. But that means that it will naturally become, rent growth is going to improve.
I was going to say either the rent growth is going to accelerate. Mm-hmm. And there's a little bit of build and they will come, and as supply recedes, demand is going to recede a little bit also. But if demand maintains somewhat elevated and continues to outpace new supply, you will see positive rent growth. So the question is, what are you going to see first? You're going to see positive rent growth that allows development deals to pencil, or rates going to fall to allow development deals to pencil. Now, it could be a combination or a little bit of both, but right now we're not seeing rent accelerate. We are seeing, to your point, Matt, regionally, the Midwest, 3.2%. That's pretty damn healthy. Northeast, 2.8%. And then, the South is at -% and West, basically flat, 0.1%. But, we're in an environment where, the Midwest, as, again, there's still units that are being absorbed right now. We could be seeing 4% rent growth in the Midwest. That's not outside the cards, and maybe the South will recover in a year.
Yeah, that is very possible. That's something that in our most recent report, we looked at a couple of these high supply. We looked at Austin and Phoenix and Denver, and some of them, especially Austin, they've got the job growth there that they really could bounce back a lot sooner than one might think, considering they've got such a big hole to dig out of, metaphorically speaking. But man, it does also look, though, like the Midwest is pulling ahead, very clearly ahead of the Northeast. It was a little bit closer, I think, maybe last month, but the Midwest, 0.4% higher rent growth, and they are now number 2 when it comes to occupancy. Things are looking pretty healthy. But overall, what's funny here is, again, like they spin this as resilient demand. And still muted rent growth. The rent growth monthly that is reported by RealPage, or the year-over-year rent growth, is the same as was reported in CoStar. It's just it's just a little different. Yeah, like it's they can spin it differently. I think CoStar is it's a little more notable, I guess, if it's the lowest since 2010. But all in all, I think that these are hopeful numbers. It is. I feel like I've been repeating this. It's like, now is the snapshot doesn't look good, but man, it's just right around the corner. Well, the data keeps coming in that suggests, it is. There's going to be positive growth there, and especially if you just look in the right places. And that's probably going to be the story throughout 2025, maybe a little bit into 2026. But it's hard to find any more regional variation than we are right now with such a stagnant.
I think it's also to note, as we have in the past, is some of the comeback of some of these primary gateway markets and cities. And I would say this is a kind of a recovery from some pretty deep correction that many of these markets had, especially San Francisco. San Francisco just saw precipitous just drops. There was just the gravity was just bringing those rents, all the way back down to earth, as they were just sky high and a little insane. Everyone left the city, the Bay Area, for COVID, and people are coming back, I guess, and they got some of the homeless problems figured out, I guess. So 6.2%, it's a lot, but again, you have to look at all these numbers. You should look back over the last several years and say, okay, 6.2% is great, but you just you lost 20% of your growth over the last couple of years. You're growing out of the hill or the hole that you dug. Chicago, a little bit different story. Somewhat similar. Been really kind of flat for a long time, but Chicago's been accelerating because there's just been no really new. Not a lot of development. I wouldn't say no. There definitely have been some nice new properties built there, but especially in the Loop. No one wants to. There's so much hesitation of building in Chicago. Yeah. We're in Indiana. Chicago is zip right up the interstate from us. We don't buy in Chicago. We don't buy in Illinois. It's just the taxes, unfunded pension liabilities. They can make a decision that how they're going to change the way they're going to assess properties in Cook County, and
it just means more work. You'd have a lot more homework,
more homework and more risk. They can make a decision that lowers your property values in half, or frees the market. But if you're comfortable with dealing with that,
that's what.
Whoa, you've done pretty well.
And that's kind of. I remember. I think it was last week. We're talking about the mayoral candidate, the New York Zoran Mamdani, and how maybe he'll freeze rents or not, but there's going to be private developers or private owners that find a way to make it work. Someone's going to do it. But
supply and demand is going to prevail at some point. If there's only so many of the units, no one wants to build more units. Someone's going to want to find a way to pay to get into those units. It's interesting. San Francisco, New York, Chicago all have the strongest rent growth, and they have some really pretty, relatively restrictive, housing policies. Just interesting to note.
Yeah.
And it's a handful of Midwestern cities on this list. Not as many, a lot of ties. After San Jose coming in fourth place of year-over-year rent growth, or year ending June 2025, you got Cincy, Minneapolis, Pittsburgh, Kansas City, Boston, Columbus, Detroit, and Richmond. So
yeah, and then they've got the tourism market's faltering. That I think that's a little bit interesting. I saw LinkedIn post a couple weekends ago that said something about had a similar point about Tampa, maybe that it was affected by lower tourism numbers. I'm not sure. I haven't looked into that, but I think that may be more of just a snapback from these used to be hot markets, and now they're just growing a little bit more slowly.
It is amazing when I look at these lists. What it reminds me is going to multifamily conferences over the last 10 years, and I'm just doing deals in Indiana, and everyone's like, interesting, Indiana, and everyone else, regardless of where they're from, they're all in these hot markets, and these are just the lists of multifamily syndicators, the markets that they would choose to invest in. It's like, this is the list: Austin, Denver, Phoenix, San Antonio, Orlando, Dallas, Nashville, Vegas, Atlanta. This is where everyone was trying to get into. And I think about that because there was so much retail capital that entered into multifamily investing over the last year. You go back to 2012 and the Jobs Act that Obama signed that allowed for crowdfunding, that allowed for Reg D 506C syndications, which means I can raise money for an apartment or for any kind of deal, but in this case we're talking about multifamily deal, and I can advertise it. Yeah. You used to not be able to advertise your apartment investment prior to 2012. It was illegal to do. Now you can, if you're only opening that investment to accredited investors. And so people went and started advertising these apartment deals. And again, the vast majority of them were in the Sun Belt, in these markets, and there's just a lot of retail capital that was introduced to multifamily syndications. Yeah. And they're going through capital calls, distress, loss of equity. And I just think it's unfortunate for the industry to see those kind of losses, so early. We've always talked about geographic, sponsors diversification, geographic diversification, asset class diversification, getting some Class A, some Class B, even a little bit of Class C, because all of those three different, kind of variables can perform differently. Obviously, the sponsor diversification is key. You think you've got like the right team, they just look good, sound good, and end up not being the real deal. Sometimes it's hard to judge a book by its cover. Regional variation.
And be aware when the story changes. So it nimble. Was a story that the South was great, hot.
And it was. You crush value add deals, you flip them every, 2-3 years, bridge loan, cash out, 2-3x, do that a couple times.
But if you're not going, if you're not tuning into the Gray Report, and you're not going to the conferences or talking to to your investment sponsor or other people, if you're not staying informed, you may still think, the last time I looked, Phoenix was great. Like, I don't get it. What? And then you're behind. And it's these stories that have a real persuasive power. You can put any number, when you're looking for, we were going through this yesterday and saying like, man, these people, look at the numbers they have for like 30% IRR.
I know.
You can put these numbers on it. I guess you can. I didn't know you could, but you can.
These ads for syndications. They're doing it on CPI too, apparently.
That's good. No, but these ads that we were looking at have promised CPI that's so high.
Returns.
The returns are I'm sorry, it's promised CPI. Yeah, the returns are so high. You can put that number in there. I mean, that's what we're targeting.
We're targeting 1,000,000%.
And so in a world where those numbers are, you take that with a grain of salt, the narratives and stories behind it get even more persuasive and important. Like, oh, okay, well, I'm ignoring the number, but I always know that story about the South. Man, that's great, so let's do it. And so I just think that staying informed and knowing where things are
classic.
going.
Blake and I were joking about this. So many investors, they want whatever, in quotes, air quotes, very conservative underwriting. Yeah. They want 8% cash on cash year one, 20% IRR. They want you to use a 6.5% exit cap rate, 3% or lower rent growth. Yeah. And all those return metrics. And it's like the you've never underwritten a deal, obviously. Because
This math does not work.
You can't. The math just doesn't work.
Yeah,
It doesn't work like that. No, you have to be informed, and I think that's going to lead into the problem we have now. Is that there's going to be a lot of investors who will say, well, the family isn't good to invest in, especially right now.
Yeah.
Because of recency bias. And they're just going to be hearing about, well, rent growth is negative right now. What are you talking about? I just looked at the apartment list sheet and we've been in negative rent growth for years.
Yeah.
No sign of recovery. Why would I invest in multifamily? You have to be very nuanced and say, oh, well, have you been breaking into the regional data and the submarket data?
Yeah. Nerd.
Yeah, exactly. And they're like, oh, well, I really like the Corn Belt and the Midwest. Have you looked into Indiana and Ohio? And they're like, no, I haven't. Why? You don't listen to the Gray Report.
And that's our responsibility too. Yeah,
that's why we're here. If you just subscribe to the Gray Report, when we started it back in 2020, which you can do right now on YouTube, or go to graycapitalllc.com. You can sign up for the Gray Report newsletter. That, dare I say, that if you would have been subscribed starting in 2020, you would have avoided some of those capital calls you've faced recently. And not only that, if you're an accredited investor, you can sign up for the Gray Capital Investment Portal, because we are getting ready to launch a new deal, A-class, in Indianapolis MSA. We're smoking. We got a mid 5 cap, brand new construction. It's stabilized. It was just delivered last year. We're cash flowing out the gate. We're buying it for less than you could build today, but it's stabilized. We just saw the metrics, Matt, of starts have been absolutely falling off a cliff. Construction has been going down. Absorption has maintained very high level. So we're buying. So if you could build something, if you could just say, we want to build something, have it delivered tomorrow, have it fully stabilized, you'd pay a premium for that.
Yeah.
But we're buying this at a discount, what it would cost to actually build it today. It's going to be cash flowing. We're going to be raising a lot of money to do it. We're talking tens of millions of dollars. We've got already millions in commitments already from our existing investors. You have to be accredited. But if you're like, all right, I've been listening to the Gray Report for going on 5 years now. Haven't led me wrong.
That's
shooting it straight. Not pulling any punches. I'm excited about Indianapolis, the Midwest in general. This is just a solid. It's a flight to quality. I mean, the risks are again can't go into all the details of the deal and starting to hijack the topic. The risks are. We just see just a further decline in prices of multifamily prices, including A-class. Just a huge,
I would say
huge
it would be like national level, like
national
macro
level
risks,
like absolute recession. That risk is present always.
Yeah.
If there's a massive recession, it's not going to be good for anything. But apartments are significantly more resilient compared to other asset classes because at the end of the day, people need a place to live. There is relatively inelastic demand, and especially in a flight to quality. If you have the nicest, newest thing, you can buy occupancy. You can lower your rents and keep your unit filled. If you're the crappiest place on the block, it's going to be hard to compete if the nicer stuff lowers their rents a little bit. So you might not get the growth that you want, but you'll at least be able to stay occupied, batten down the hatches, and get through the storm. But I don't see, again, there could be a recession. The probability has ranged this year anywhere between 20% and 60%. Call it 50% today. I don't know. But
my vote's on continued uncertainty and stagnation.
Which
I want to wink.
And that's the reason we're able to get this property is because there's so many people that are on the sidelines, unwilling to make a decision. But we're looking at the long-term prospects the next 5 to 7 years in the nation, but specifically in Indianapolis. And we're like, we've got a really nice runway here. If you started building today, you're not going to deliver for another 2-3 years, and you're not necessarily starting today. And if you do, it's going to be for a higher price at higher rents.
And we mentioned that there's that general narrative of the people paying attention to the South, but something that we noticed even really kind of earlier this year, there's a lot of people that are interested in Midwest Indiana apartments. And so
what happens when
that's getting hot?
The institutions are not yet present in the Midwest, especially Indianapolis. They've been in Chicago obviously in the past, but not as much. If I'm not saying when, I'm saying if.
I'm saying when.
You're saying when. The institutions are like, we got to get in Indianapolis, Columbus, Kansas City. that's an instant cap rate compression across the market.
And there was a few weeks ago where we talked about, there's a Marcus and Millichat video that talked about how cap rates between primary and secondary markets were starting to, like that gap was starting to shrink. And I just think it's a matter of time before they kind of notice and before there becomes a critical mass of liquidity in some of the smaller markets where institutions are willing to just jump in and make more money than they're making elsewhere. That's what I was talking to John, is like thinking about ideas for another research paper is you are getting a better cap rate in some of the Midwestern markets than you are in, let's say, like a gateway market. And it may be slightly more risk. It may not be that much more risk.
I mean, it's the basic thesis that we've had since day one, is that there's an unfamiliarity with the Midwest, and so a perceived level of risk, and a lot of that does have to do with liquidity. There's not as much liquidity. Never had a problem selling a deal in Indianapolis. If you're in like a super tiny market, like maybe there's only a handful of folks, but even then, that risk I think is overblown to a great degree. Yeah. So there's just an unfamiliarity with the markets. There's a level of perceived risk that isn't appropriate, but therefore you're getting a discount on the price. Yeah. But then you're going out and getting the same kind of debt that you'd be getting on an asset in a primary market. I mean, can there be some like minor differences on, maybe how much interest only, a lender might give you, because whether it's in Boston or in Indy? Not really. Yeah. I mean, maybe if it's like Bloomington versus Indy, because there's like thing called like peer-reviewed state or pre-reviewed states, and whether they're like automatically approved or they have to be underwritten. But you're getting the same debt, but you're getting a better cap rate. And then you'd say, oh, well, the growth has to be much lower because, otherwise, why are you getting such a good deal? The growth can be higher than in the Sun Belt. We're seeing similar amount of growth, higher in all these Midwestern suburbs than you're seeing in the Sun Belt. So you're getting a discounted price. You're getting higher rates of growth. You're getting the same amount of debt. I mean, I just call it basically geo-debt arbitrage. Yeah. You're taking the higher cap rate in one region. You're taking the debt that you can get anywhere. You're applying it, and you're getting a spread. You're just getting a better spread, and you're getting a better yield. And then you combine that with actually knowing the market well, having ingrained knowledge that gives you a tactical advantage on finding the deals, managing the deals, and just access to vendors and the rest. Yeah. So I would love to say that we planned this from the beginning, Matt, but it's just we're in the right place, and that's why we've launched the fund. Now if you're just an accredited retail investor, you're investing $100,000, $500,000, that's what we have our direct deals for, which we're going to get ready to open one. If you're an institution, a family office, you're investing $1 million, $5, $10, $25 million, we have an institutional fund for you as well. Learn more about it at graycapitalllc.com or graycap.net if you're into brevity. Return to our normal programming, Matt. What's next? Okay, so it is a little bit of shifting gears. Not all is well for every single multifamily syndicator. I think that we have sketched that out enough today, especially when it comes to loans. I know we talked a lot about loans, and they're not going away. In fact, I think they may be getting worse. Multifamily properties, this is a quote from this CredIQ article that's right here. Multifamily properties recorded net losses in Q1 2025, which are the highest since 2012, which just highlight the challenges in multifamily. And the delinquencies have surged. Yeah, that's a little bit of a scary climb right there. Yeah. In 2020, multifamily delinquencies were $1.5 billion, which is 0.3% delinquency rate. In 2025 is $9.4 billion, which is 1.5 delinquency rate. That means that's a 500% increase. And compare that to what they're calling core CRE, which is everything but multifamily. They went from 1% to 1.7%. So that's only a 70% increase in delinquencies compared to multifamily alone, 500% increase. And also when you're considering that a lot of the core CRE delinquencies are probably office buildings, that we all know what happened to office buildings during the pandemic.
I think that it just shines a spotlight on multifamily and their loan troubles, and it's not a good spotlight. It's like the spotlight you're trying to escape prison in dark, and the guards find you, and there you are.
It's not the bat signal.
Good. Yeah, yeah.
I mean, I think it's a case of the higher they climb, the higher there is to fall.
Yeah, that's a good point.
The multifamily prices were so inflated, especially in the Sun Belt, when we saw those, 3 cap deals, 2 cap deals, crazy stuff. And I mean, industrial saw some crazy pricing also, but I mean, like you said, office definitely didn't. And office is a huge chunk of the market. And yeah, again, you can't pay a 2 cap and then have negative rent growth and on your interest on your floating rate debt, quadruple and make it out alive. There's just, again, it comes back to math. Mm-hmm. And I'm not even like the best at math, but I know that math and it doesn't work.
I think what we said, this was maybe 6 months ago, or multifamily loan problems have been persistent and they've been kind of smoldering in the background. So this is what we've been discussing for a couple of years. And most recently, I think, was this idea that, well, these loans are probably for bad properties, not necessarily bad properties, but like Class C, not your luxury properties, more like maybe the Class C that you wanted to fix up. And now actually with higher interest rates, you're in trouble there. And maybe your expenses are going up and you can't fix them up and you're not getting the rent growth because you never got them fixed up. And so
problems get worse.
Yeah. And it's like, and I remember you saying this, and it's like, who's going to buy these properties? And there's maybe a market for really nice ones because we've gotten all these deliveries.
Yeah. There's a flight to quality right now. Like we were talking about, It's like, let's go buy the nice new thing. You can get it at a decent price right now.
Yeah.
But that means the alternative to going by the crappy property that's been, beaten to the ground, troubled resident base, no one's paying rent, you need to spend a lot of money. Like, you really need to be compensated to go and do that.
Yeah.
Like just the amount of work it takes. I mean, to find a manager to go and work on that site, to execute that business plan. I mean, it's a lot of work. And then if you're not going to make any more money,
I know, and
no one's going to do it. So the cap rates have to be so much higher than they are today.
And we again, in our discussions, we talk about the prototypical troubled borrower, multifamily borrower. He's got a Class C in Austin. Maybe it's not doing great. Got a loan on it, facing maturity. The last thing he'll do is tell his investors that there's a problem and get a capital call. Okay, but before then, he can talk to the bank or he can get pref equity, which is like private credit.
Yeah.
We've seen articles that were written in the past few weeks about, hey, investors, you need to think twice about private credit. There is some risk. Even these private credit, it could mean that's not like a guaranteed. It's a little bit. There's a little bit of risk because if you're getting private credit on a deal that's not doing really great, that's also added risk.
I'm really. I think that there will be some shock to the system. I don't know how great, depending on the timing, and I don't know what a catalyst would be. Hopefully not, but. Yeah. That is a worry card that I have, is all of the pref equity and private credit, because so many investors were blind to the risk because they were like, well, basically they were like 10%, 12%. Where do I sign?
If you're getting paid first, but there's no money to pay anyone.
Well, and they're not getting paid first. They're getting paid before the common equity.
Okay.
So you're up in the stack, but you're not like
pay the bank.
You're
first.
not. You're paying the bank first, and so but that means that the bank's got to be paid back first.
Yeah.
So that doesn't mean that there's someone in front of you in line. You're just like it's like you're getting like the premium economy. Like you're getting a little bit of extra leg room. But you're paying like hundreds of extra dollars for it, and then like you get to board. The
plane is losing altitude.
Yeah, right. It doesn't matter. If
you don't reach your destination, it doesn't matter where you're.
And then
you're
looking around, you're like, I paid like 5 times the amount for like boarding like 5 minutes early.
Yeah,
and I don't even get like a free drink.
And now there's smoke coming out of the engines.
Yeah, what's the point? So I think there's just big risk, because I don't think people underwrote risk. I think people just got greedy with I need to replace my yield. I was getting 8% in my real estate. I mean, you used to be able to count on. I used to be able to, if someone was like, I need to get 8% from real estate, like that's easy. I'll go out any deals that were not 8% because the preferred return's 8%, and almost all deals were paying current 8% pref or more. It was easy to do.
Yeah,
that went away. Then it was hard. It's harder even to get 6% out of a real estate deal on common equity today. So you have this whole investor base who has been using alternatives as a substitute for fixed income. And then those alternatives, the real estate stopped producing those types of returns, maybe even worse, they had some losses. And so they're like, I don't want to take that amount of risk because it's not even producing the yield. Let me take less risk, especially if I can get some more yield, lower total return. So, I'm not going to maybe 2x or 3x, but I'll take my 10% a year. I'll take my 10 IRR over a couple of years. Some of those deals are just fine, but
you have to balance the actual deal that the pref equity is used for.
That's the key.
Yeah.
Is what deals are they going into? And we tried to raise a pref equity fund because we're like, there's obviously a huge demand. There's investor demand for this type of return. Yeah. There's going to be distress in the market, so there's going to maybe need to be some rescue capital out there. But all of the deals that wanted to use our pref equity, we were like, there's risk of the pref equity getting wiped out. Yeah. And these deals aren't worth doing.
As an investor, though, and would you be able to find out what deals, and this is just inherent in any fund, I guess, but like you invest in that pref equity, it's up to your sponsor to pick the deals that the pref equity gets deployed in.
Yeah, and they don't really make money until they deploy the capital. So like, the money's sitting there as dry powder. Their incentive is once they've raised the money, because everyone's like, ooh, when am I going to get my 10%? You got to put that money to work. And so they're putting it into deals. And it'll work for a while because, like if it's a new deal, they're probably borrowing the money to pay the interest.
Yeah.
Part of the funds are going to pay back the pref. Yeah. So that only lasts as long as the money lasts for. And then once that's dried up, they're hoping that they've either been able to refinance the property because rates are lower and rents are up so they can pay back the private credit preferred equity, or rent will have accelerated. Their expenses have been lowered to a point of where they're cash flowing enough to be able to pay the distribution to meet the pref. None of that's happening. Because those are all the same people who are like survive till 2025. There's going to be much lower interest rates. In the middle of next year, we'll be able to sell this deal in San Antonio, Texas, or Austin, or Atlanta, or Phoenix, or Vegas for a 4 cap or 4.5 cap.
Yeah.
Everything will be fine, and everything is not fine. None of those things are happening, and we're not really close to. At least not in the immediate future. Yeah. And that's where we're coming back to this TREP piece. Yeah. That's why we're seeing these delinquencies pop up, because everyone thought by this time in 2025, we'd be seeing lower interest rates. Yeah. And as we said earlier, people were forecasting maybe higher rent growth, not because there was any data showing that there was going to be higher rent growth. It's because that's what the market was demanding. Yeah. That we need higher rent growth to be able to get out of the troubled situations that we're in. Yeah. And so it was, the hope. And sometimes you can will that to be, self-fulfilling prophecy. But like in this case, when you're delivering this many apartment units, you could. Look, the absorption is trying. Like, it's amazing the amount of resilience.
No, it's not it's not crashing or going down. It's just not growing they wanted to.
It's just not enough. And there will never. The problem for some of these assets, it's never going to be enough. Yeah. If rates went to zero, like it might not even fix it for you. It would certainly help a hell a lot. If rent growth went to 10% tomorrow, that wouldn't help necessarily. You need to turn over the whole rent roll. That's going to take a year. Really, the only thing is if interest rates did go to zero, that would help. Yeah. But that's not happening unless there's an outright recession. And if the outright recession happens, there's going to be calls on capital because there's going to be liquidity. There's going to be liquidity problems. Those loans are going to be called, and those lenders are no longer going to say, yeah, Mr. Syndicator, multifamily borrower, we'll give you another 12 months because we've just given you 36 frickin' months. Yeah. Now we don't have any money. Our everything's getting called because it's a liquidity crunch. Yeah. So I'm not saying half of that's going to happen, but I think I think we're entering a period which we've kind of forecasted and talked about, and it's not going to be one inflection point, but we're entering a zone of where the rubber is going to meet the road, and where it's like it hasn't happened, guys. Rent growth isn't there, and rates aren't down.
I think Class C apartments could become the most exciting, or at the very least interesting, area of the multifamily market in the next year or so.
Yeah.
As this kind of trickles up, because at least according to my stereotype of the kind of loans that are out there, I think that it's easy. It would be easy to find a way out for a luxury building, or even maybe like a Class B that's pretty nice. Then it's not going to have as much trouble, or not going to have as much work that needs to be done with it. But the Class C properties, like I said, who's going to buy them? And when everyone's asking who's going to buy them, that means that the price is not right.
Well, so people will buy them. I'll buy them
at the right price,
but at the right price. Exactly. The price has to be so high, because it's like I don't want to deal with the headache, because my investors can make good money buying new properties that don't have all of the issues and all the risks associated with the C-class property.
Yeah.
But if you buy it at the right price at the right cap rate, all of those risks can all be quantified and mitigated because you have the money to deal with them. If it's like there's a bad tenant base, you can afford to evict a bunch of people and move folks out and tenant the property with a higher. You all of a sudden you put in better qualifications, better screening practices, better marketing. You have the ability to put the money in to fix the place up. The only way you can afford to put the money in to still have your overall cost per unit at a reasonable level is you have to buy it low enough.
Yeah.
And right now, everyone bought these old properties for 4 to 5 caps. And so to sell them at a 7 cap, which is what they would need to trade for today to make it sense for somebody like me, they're losing all of their money and then some. It's like they're maybe selling it for less than they owe the bank probably.
Yeah.
And the bank doesn't want to hear that.
Nope. Nobody does. But
nobody does. But that's what it's going to take for those properties. But a spread of maybe 5 to 6.5 between A class and C class, maybe that's appropriate because we should see this widening spread between A, B, and C. When I started investing in multifamily back in like 2015 or so, you could buy a C-class property for a 7, 8 cap. And the A-class properties might be at a 5, 7, 5, 6 cap-ish, plus or minus, depending on like the market. Go in the suburbs, Carl, maybe a little bit, or downtown, maybe it'll be a little bit lower.
Yeah.
Somewhere in the middle, it's a little bit higher. But then like in COVID, everything was a 4.5 cap.
Yeah, it doesn't, and that was another thing that Marcus and Millichap talk about regionally, and when it comes to the asset class, the C's, B's, and A's are very close together when it comes to cap rates, and I think that's an anomaly. It's not a new normal, but I could be wrong there.
Yeah, no, it is. Yeah. And so I think that there's less room to move on the Class A's. I think they're going to stay relatively, kind of compressed. They're not going to – I think that there's limits on what they can expand because there's an absolute bid on the Class A stuff. The Class C, there's no bid. That's where we're going to see the major expansion. And so right now, if you're looking to get in, if there's going to be some rent growth over the next couple of years, I think the A class is the where to be. Up until that might work for an extended period of time. You have to be on the lookout for when the Class B and C starts going on fire sale and buy it. But I would only buy it if it's a true fire sale. And there'll probably be some like middle of the road opportunities in kind of the B class space. But even those, you have to get at a really attractive cap rate and price to be excited about.
Yeah. A few months from now, it's going to get interesting. It's going to stay interesting.
It's interesting every single day.
That's right.
And every single week in multifamily, things aren't supposed to move this fast. As like I was talking to Carl Whitaker, it's like back in the day, it was kind of like, quarter over quarter, nothing news, market growth is 3%, jobs, there's a little bit change in supply, man, it's a different world since COVID. And that's why we're trying to be here at the Gray Report, try to keep you up to speed.
That's right.
Keep you locked in check. Make sure you subscribe to the Gray Capital newsletter. Click the bell icon and subscribe to the YouTube channel if you haven't done that. If you haven't done that and if you're listening at this point, it's just what are you doing? And again, I'm really excited for this new deal. We're going to be launching it soon. You need to get on the Gray Capital investment portal. Hop on over to graycapitalllc.com. We've got testimonials, we've got case studies, we've got all kinds of decks. We do more research and work on our deals than anybody else. And we want to show you what we do and why we're so passionate about doing the deals that we do. So check us out. Schedule a meeting with the Great Capital Investment team. Learn about our new deal that's coming up. It's an awesome deal. It's again, like I spend a lot of time now. It's every deal, but like the holes I'm trying to poke through the deal are they're kind of existential and of like, yeah, well, nuclear war.
Yeah.
Aliens. But there's like some asymmetric upside also. It's like, here's a base case. It's conservative, just constant cash flow, kick off 6% starting in year one. And then I'm like, okay, these are all base case, just kind of slow growth, steady Eddie, getting at a good price. But then it's like, if this happened or that happened or this happened, value pops.
Yeah.
And that would be cool. We don't need that to happen. We're not underwriting that, but it's a good time to have some perspective over the next 5 and 10 years. Because I don't think a nice new multifamily property in a growing desirable area is going to be worth less in 5 years than it is today.
I think that and it really, to sum up the reports that were, this week and last week, the multifamily market it's never been more clear, the kind of turnaround that we're facing. It does look like it may have stagnated, but all these indications are that that there's going to be a real uptick, I think, in multifamily performance, and things are changing meaningfully, and it's not going to be the same. Crossing my fingers here, because it does seem like I always eat my words here, but the more data we see, the more signs that there's going to be a real turnaround in 2026, and especially when it comes to construction. So there's lots to look forward to.
Believe it when I see it.
I know.
No, a lot of good data. All right, thanks for watching this episode of The Gray Report. We'll catch you next week.